Okay, good morning, everybody. Thanks for tuning in to this week's Spiders preview. We're going to be taking a look at the sectors that make up the S&P 500. Specifically, we're looking to identify important trends and important levels of supply and demand. Because if you know where these are, it can help your trading decisions. This is really more of a roadmap than trading recommendations. I just believe that if you're a trader and you are aware of these dynamics, it's going to help your style. And if I see things that I think are worthy of a trading recommendation, I certainly point them out. You'll see that when we get to the XLEs, the energy sector. The 74 level has been really clear support over the last few months, and I don't think there's much support beneath it until we get down to around, say, 68. So watching that 74 level for a break for a potential short. But we'll look at that more when we get there. All right, so as we all know, in markets, there are certain price levels that are more significant than others with regards to the amount of supply and demand that exists at them. And in markets, prices are always doing one of three things. They're either going up, going down, or staying the same. So this sounds pretty simple, but if you can recognize where these levels are and where these trends are, it's going to help pretty much almost any kind of trading or investment strategy. I don't do any of this esoteric stuff like Gann theory or Elliott waves, and I just don't think there's any validity in it. I mean, I've never been able to make any money off of it. You can't really just apply like things like harmonic charts to a market and be like, oh, blah, 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 blah. Here's where it's going to go. Here's my price target. Here's the day it's going to get there. The real classic technical analysis techniques, which there are validity to, such as trend lines and recognizing support and resistance, really illustrate the supply and demand dynamics that are going on in a market, at least if utilized correctly. All this other stuff, I mean, I did a long paper on Gann, and I actually read all of his books, and the stuff that he came out with is nothing like the Gann people see today or talk about today. If Gann himself saw a Gann chart, he wouldn't even know what the heck it was. Basically, he was a stockbroker that didn't do so well, and I don't hold that against him because I could never be a salesperson. And he started a newsletter, and he was moderately successful. And in his books, it's kind of funny. One of the things to remember is, or to realize, is that he was a really, really hardcore right-winger, and he wrote during the New Deal, and he hated Roosevelt. And, you know, he talked about how the country was basically going to collapse. When the Dow Jones, I believe it was at 136, he put out a letter saying the Dow Jones will go lower and will never get to the 136 level again in history because the country's about to collapse because of the New Deal. So clearly, in hindsight, he was wrong, but you don't really hear again people mention this because most people don't even do their own research. They just see a Gann chart and they, you know, try to come up with some conclusion from what someone who doesn't know what they're talking about is telling them. But if you read his books, which are definitely worth reading, when I would recommend it, you would learn that what he talked about is nothing like Gann people talk about today. So I was a trader, or I am a trader for more time than I care to admit, and I traded a lot of illiquid things. So just over the course of years, you learn how to identify these levels. So this is just a brief overview of what's going on. We'll skip this and go right to the SPYs. Okay, so the SPYs have been consolidating over this important 280 level. You can see 280 is important because it was resistance here, it was resistance here, it was resistance here. But each of these times it became overbought. See? Overbought above this Bollinger Band, which shows that it's more than 2 standard deviations out of its normal trading range. And as we all remember from statistics, not me, I had to look at Wikipedia to recall this, is that if it's within 95% of all trading should be within 2 standard deviations. So if it gets out of that range, it's either going to revert or you're going to have a new trend. So you should always pay attention to things that are overbought and oversold. And when I talk about overbought and oversold, that's what I mean. Something that's out of its range, like this. See, oversold, and what happened? You got a rally. Here, oversold. What happened? You got a rally. Here, oversold. You got a rally. Now, recently, the SPYs got up to the 280 level again, and they were not oversold. They spent about 2 weeks consolidating, and they ended up getting above it. So that's what we talked about over the past few weeks, is that the consolidation most of the time means a continuation of the trend, right? When something is trending and it gets to an important support or demand level, or supply and resistance level, if it's overbought or oversold, it tends to revert, and the trend tends to revert. If it spends time consolidating there, it tends to move ahead. Okay, so it's just important to watch. We identified this little reversal pattern last week, and we said we were going to be testing the 280 level. So going forward, I would keep looking for support at 280. The top of the range has been around 280, 350. Look at that. If it breaks above this, we're going to probably have some resistance around this level, 286, because it was the all-time high in January. All right, so here's a look at the XLKs, the tech sector, and this is almost 30% of the SP 500 makeup. Last week we talked about if they broke down or sold off, we'd find some support at the 71 level, which they did. We were able to identify this level as being important because guess what? It was the all-time high here, and it became oversold, and guess what? Oh, it sold off. Big surprise. So anyway, because that was an all-time high, it became important, and you can see it was support here through June. All right, it was kind of an important level here when it had this big rally. So anyway, it closed above the 72.50 level, which was important because you can see it was resistance here and support here. So if this thing holds 72.50 and the financials can break above their level, the resistance level they're testing now, which I'll show you on the next slide, that's going to bode well, and that's going to for the bulls, and that to me will be the catalyst for the next up leg of the S&Ps and the broader markets. And this is what I mean here in the financials. So you can see this 28, 25 level has been important, right? It was resistance here, resistance here. It was a level which this big sell-off started from. It was resistance here. So anyway, so since we got to this low, it's been rallying, trending higher, or it was trending higher, but then it got to this level, and now it's consolidating after breaking its uptrend. So like I said, if the XLKs can hold the 72 level, and if this thing breaks above this 28, 25 level, I think we could see some upside in the broader markets, specifically the SPYs, which it seems like most of my clients are always asking about anyway. That seems to be the most popular thing to trade. But if you are trading those, you really should be looking at all these sectors because you can get some insight into the SPYs. Like for instance, just knowing that these financials are testing an important resistance level is going to give you some insight into how the SPYs are going to act, because if this thing breaks to the upside, you're going to just see like a real jump up in the SPYs, and the idiots in the media are going to be attributing it to like trade wars or what Donald Trump said or this, that, and the other thing. But in reality, it's just because an important level was broken. In the markets, most of the time when things are moving, it's because something has an important trend break or something is trading off an important level. It has nothing to do with what the media is attributing to. A lot of times movements are just caused by noise, okay? Like for instance, like in here, that's probably just noise. And when I see noise, I mean trading that's just like part of everyday trading. For instance, if you're a hedge fund manager and you have 20 stocks in your portfolio and a client calls and says, I'm depositing $50 million in my account. Well, if you're the hedge fund manager, you need to go out and buy those stocks to have your client's account be in weight with your strategy. Well, say the same day someone else calls and says, I need to withdraw money. I'm going to withdraw $20 million out of my account. Well, now the traders are literally buying the same stocks that they're selling, because you can't switch that from one account to another. you have to trade it through an exchange. So that's going to cause noise. That's going to cause the stocks to move. It has nothing to do with supply, fundamentals. It has nothing to do with what some idiot on CNBC is saying. It's just random noise. And that is 95% of why the market moves. Random noise or because of the supply and demand dynamics. I've been doing this stuff for 25 years now, and I can count probably on one hand the amount of times some surprising fundamental news came out and it moved the markets. And again, let's talk about supply and demand. Okay, I like to show this chart to people that don't believe charts. See here, the market rolled over here. This is financials long term. It's the exact same level it got to back here in 2007 and before the market broke down. So how can that be? I mean, interest rates were different. We had a different president. Oil prices were different. But yet somehow this rolled over at the exact same valuation. So this is really mass psychology, and it's really an extraordinary phenomenon, and very few people actually think about it. But I do, which is why I have this webcast and my site. This is the healthcare sector. Caught me a little off guard last week because this is a little reversal pattern. I kind of expected this, but I don't trade it, so I don't really care. It's not like I lost any money. But these things have been exceptionally strong. But you can see they're overbought. There's going to be resistance in this zone because this is where the all-time highs were back here in January. If it heads lower, I'd look for support around this level because that was the bottom there, because it was the top back here. And it will probably be support again if these things trade lower. Okay, here's consumer discretionary. We mentioned 2 weeks ago, keep an eye on this 110 level. It should provide some short-term support, which it did. Really just consolidating around all-time highs. So going forward, look for short-term support at this level, intermediate at 107, because this was the top here and where this rally started from. It's always important to watch levels. When an important level breaks and a rally starts from there, that tends to build more significance than, say it just kind of sputtered along and rallied when it's like a sharp move up like that, for instance. And then longer term, if we get down there, months or years from now, just watch this 98.50 level again. And you can see here, right, oversold reversion, oversold reversion, because it's at a level, important level, I mean. Industrials, kind of similar setup to what's going on in financials. You can see they tested this 76.50 level, which was resistance here and here and here, but it became oversold, reverted really quickly. Now we're kind of just consolidating, testing the trend. So keep an eye on this, because if this trend breaks, we're probably going to get a tradable move down. And if this level breaks, it's probably going to get a tradable move up after this consolidation ends. And again, you could see the 71 level was important there, 71 was important there. Again, ask your academic friends, how can that possibly be? How can they have the same valuations if you're using the FAMA model or the capital, or the Markowitz? It's been a long time since I was in business school, but I remember a lot of the fallacies they used to teach us back then about efficient markets. And traders have always known that people have emotions, and now it's actually becoming legitimized after 300 years of there being markets by academics, and they call it behavior psychology. Because when you take a position, you become a member of a herd or a group. Markets go down on fear, they go up on hope. think about perception biases or just biases like why do people wear ties, right? Why do you think a tie looks nice? I mean, it's ridiculous, right? In 300 years from now, if we still have a culture, people are going to look at people wearing ties, or look in pictures at least, or in history of people wearing ties, and think it's as ridiculous as we think that George Washington and all those guys dress with their tights and their ponytails. But that's because we are animals and we have herd instincts. And if you know that, and if you're aware of that, it's going to help your trading. Like I used to see it every day when I worked in the city. You get to Grand Central, and these trains kind of go the way they park and get the customers are kind of away from the station, as opposed to being parallel to it. So people have to walk from the front of the train, and then, well, actually, if you're leaving the city, the end of the train would be the first thing you get to, and then the front the train would be the farthest thing you get to. And there's a platform along that. But anyway, you always see all these people getting into the first car, and they're complaining to the conductor because there's no room and they can't get a seat. And meanwhile, if they just walked around the crowd and walk up to the front of the train, there is totally empty seats. You can have 3 seats to yourself. And that's an example of herd bias, or people being animals, because everyone sees that. Not everyone, but most people see that group of people, and they think, oh gee, we got to get into the first car here, so they follow them in. And that's a completely illogical thing to do. Just walk up 3 more cars and have your own seat. But you see that right there in Grand Central Station is an example of why there's validity in understanding chart analysis as not voodoo, but a study of mass psychology. These consumer staples, we identified this 5350 level last week as resistance. It broke it, overbought now. It was support here, and it was resistance here. So now my guess is that going forward, there's going to be some consolidation, and watch 5350 for support if you're trading this thing. Here's another interesting chart for people that don't believe in charts. Look at this 50 level. It was the top here through about 15. And keep in mind, this might look choppy, but, this is 51, this is 49. I mean, that's a tight range. There's really not too many fundamental analysts that I've ever known that can have such precise price targets. Because, if you follow what I do here, you've known for, I don't know, like 2 years, maybe, that I've been pointing out this 50 level. And sure enough, when we got down here, what happened? We rebounded. You might say, well, Mark, it's not 50. Well, gee, I'm sorry, it got down to 49. Again, find me a fundamental analyst that can make a price call that quickly, or that accurately, and let me know, because maybe I'll start following his website. All right, sorry, I think we're having some technical problems, but they're telling me that we're back online here. All right, so anyway, back to these XLEs. See, it was pretty clear. Support here, was resistance here. Now I'm looking at this for a potential trade, like I mentioned at the beginning, because when this thing traded up, it really didn't form too many levels that would be support. And you can see that's kind of a mirror image to it here going down. It really didn't form too many levels because it didn't spend enough time there for levels to become important. So when it traded up, it just traded up right through them because there was no resistance. My guess, if this 74 level breaks, it's going to be the same thing on the way down. You're going to get, a sell-off that looks kind of like this. And I would have, this is a short, so I would have probably my sell short stop at 73. My buy to cover would be at 74. My target would be here around 68.50. So that's could lose $1 but could make $3 scenario. So I like those risk-reward ratio dynamics. And again, here's another chart for people that don't believe in charts. Somehow, miraculously, the market had the same valuation here as it did here, as it did here. So if we rally again, which I'm sure inevitably we will at some point in the future, before I'm pushing up daisies, assuming our country isn't destroyed by a meteorite or whatever, there's probably going to be some significant resistance around this 78 level. And if it breaks out, we're going to have a nice move on the upside. But this is something that's going to play out over weeks, if not months. So don't look for this as like an immediate trade. All right, materials, the most boring sector that there is probably. I've just been kind of consolidating above this 58 level. You got resistance around 59.50. So those will probably still be important going forward. And last but not least, utilities, a sector which is boring most of the time, but gets exciting at times like this when they act like a biotech stock because there's stuff going on in the interest rates markets, or at least that's what the media is focusing on. So, all the talk of raising rates started around here, and now it's kind of just trading sideways, testing the top of its range. All right, so anyway, folks, that's it. I got a tea time in a half an hour, so wish me well if I play well, because then I'll be in a good mood tonight. But I guess we'll be speaking next week for next week's SPDRs report. Till then, have a nice week, and just remember, come up with your own ideas. Don't listen to the morons on television, and you'll have much more success. Okay, thank you. We'll talk to you next week.